Welcome to Power Charting. I'm Bruce Fraser, your host, and we have a terrific program planned for you today where we're going to be talking options with Felix Frey. And Felix is one of the really outstanding, knowledgeable people on all things options, and he's going to show us his incredible options tools that he has created for us to be able to trade options more effectively. But first, before we get started, just an announcement that the TSAA-SF is going to have their annual technical analysis conference in San Francisco on September 14th. This is an all-day event and a wonderful list of speakers. There is special pricing just for Power Charting viewers. And if you put in the discount code PRUDENT, when you register, you're going to get a $125 rate, which is going to save you $50. So it's going to be a wonderful day. Lunch is included. Please join us. And then also, we have the Wyckoff market discussions, which I do with Roman Bogomazov on Wednesday afternoons. And we're going to have a special coming up. Keep an eye out for that. It's going to be 3 sessions for $30. And it's just a wonderful place for all of us in the Wyckoff Nation to come together and talk about Wyckoff and the current state of the markets. So please be on the lookout for the special that's coming in the next few weeks. And with that, we have a very special guest today, Felix Frey. And Felix has got a wonderful tool at Options Geek that he wants to tell us about. But in the meantime, what you need to know about Felix is he has 25 years of experience, specifically in the options field and with derivatives trading, and is incredibly knowledgeable and has taken his incredible knowledge and has turned it into this incredible capability at Options Geek, which he's going to tell us about today. So Felix, welcome to Power Charting.
Hey, thanks a lot, Bruce. I appreciate you having me here.
Well, let's get started. We want to hear all about what you are doing. So let me turn the screen over to you. Beautiful.
Great, thanks, Bruce. So again, my name is Felix Frey. I've been at it for 25 years in the derivative business. I graduated in '95 from the University of Pennsylvania. Went to work in Chicago and learned options from some of the best traders over the last 40 years at the O'Connor Partners. I worked for Swiss Bank O'Connor, and then I made my way back to New York to Bank of America. This is where my career sort of took off and my experience excelled. I wound up spending most of my days speaking to the top hedge fund managers in the world. From there, I had a full understanding of what they were looking at and how they approached the business. And then I actually joined one of the top hedge funds in the world for about 10 years, Scoggin Capital Management. In my 25 years, I understood that there was one question that was the most obvious question and at the same time was the toughest question. And that question was, when you're looking at options and you're trying to understand how to use options, the simplest question is, which one do you actually choose? And I spent most of my career not really understanding how to get that final answer, believe it or not. And I learned also that most people don't know how to do it. When I joined the hedge fund side, I was, let's say I was placed in a different seat with some great investors and learned a lot from that experience. I built Options Geek to translate my full experience on Wall Street into a site that includes 3 things. It includes education, it includes a tool, and then it includes trading ideas. So I try to give a full options educational experience. From education to practice to how the best guys in the world do it. So I'm going to show you a little bit of the tool today, and I will show you how I think about ideas, how I find ideas, and then how I interpret those ideas. And then I'm curious to throw it back to you, Bruce, and have you give me a lesson in Wyckoff and what those charts are saying about the ideas, I'm talking about.
Can't wait. Let's
Awesome.
do it.
So the first idea, we can cut this out. Let me get the.
Go.
So this is Sonos. This is one idea that I gave this last week. I usually give 3 to 5 trading ideas per week. Each idea has an options recommendation. At Options Geek, I keep it simple. I keep it simple because the best investors in the world keep it simple. They generally, 90% of the time, they are either buying puts or buying calls. That's it. So in this idea, I chose Sonos. So what I'd like to do is start with the idea, tell you the options, the options trading idea I was recommending, give you the reason why, and then show you the tool that sort of verifies some of the thinking that's going on behind that idea. So the idea here was a company called Sonos. My recommendation was to buy the January 17th calls. January 17th, 15 strike calls for $1.25. The stock at the time was trading $13.39. This was a few days ago on August 29th, last Friday. And with the stock at $13.39 and the options, the January 17th 15 strike calls at $1.25, that basically gives you the right to buy Sonos at $15 from here until January 17th. You got to pay $1.25 up front, okay? The first thing that how I come up with ideas, I generally find unusual options activity. Okay, so each day, unusual options activity means that each day, each stock trades a certain amount of contracts. Sono may only trade 1,000 contracts per day. Something like Apple may trade 100,000 contracts per day. So what makes something unusual is a multiple of the average. So in this case, Sono traded 25,000 call options on Thursday, 25,000 call options, and they were paying 60 cents for the right to buy Sonos at $15. So with the stock trading here, $13.39, they're looking at this level right here, $15, and they're willing to pay 60 cents for that right to buy it. When I saw this trade, the October 15 calls, it lit up, one, because I didn't know, I've never heard of the name Sono. I never heard of the ticker Sono. Also, there were 25,000 contracts traded, which is a significant number, showed me that there were institutions buying these calls. I dug in a little bit to try to figure out what Sono was so I can get a better idea as to potentially why someone would be buying the 25,000 call options in October and why were they choosing October options. Also, why were they choosing the 15 calls? So there's a lot of detective work in what I'm trying to do because I'm trying to back out the thinking of someone that I don't know who it is, except I just know that they're a large institution that has a lot of money and they're putting their money to work in Sonos. So with that said, I took the 25,000 calls, which is the equivalent of 2.5 million shares. 2.5 million shares that someone wants to buy Sonos at $15 and have that right to buy it. And I realized very quickly in just digging into the company that they're a consumer electronics company. Essentially, they sell high-end speakers, okay, high-end speakers. And digging a little further, I realized that they had an agreement with IKEA and they were launching a lower price speaker at IKEA to match IKEA's customers. Okay, so while these high-end speakers might cost $500 and up, the lower end is anywhere between $100 to $300. The second thing I did was then look at the chart. So I want to know what the company does, and then I want to look at the chart. And the chart, immediately I saw this spike here, and it looked like it matched the time frame of when the launch was going on with IKEA. In fact, it was. And so someone is actually making a significant play here, assuming that the stock will continue it's already gone from 10 to 14. It's come down a little bit to 13.39 here. Someone's making the play that it's going to go a lot higher. How much higher? Well, I have a tool
Let me just make a comment about this chart. Is Wyckofians will see in this chart the essence of a completed accumulation structure. So all the phases are in. It looks like phase D, phase E is taking place now, which is where the uptrend is beginning. And so this is when Wyckofians want to get busy, is when the uptrend is starting to really mark up in an aggressive way. And so this totally fits the logic of the Wyckoff methodology. So I'll leave it at that for now.
Great, that's awesome. Let me get the tool up here. You can always cut that out. I'm just going to try to get the
Okay, we can see the tool.
Okay, so here's the tool I built. This is SONO. Plug in SONO. We would click and go. We can choose our expiration date. I chose January 20th. Here's your stock price, $14.90. Right now, that option is worth around $1.80. It's being priced at around $1.80 in the market. The stock has moved up from where we looked at it before in the low 13s. It's climbed now closer to 15. The options have gone up from, you know, he was buying the October options. So let's look at the October. The customer was buying the October options. Okay, remove that shading here, and they're at 90 cents now. So he was paying about 60 cents. The stock had a significant move already. They've gone up to 90 cents. I liked the January options because to me that launch, if it was successful, will appear in the expiration, in the later expiration when there's earnings. So earnings are in November. And what this tool does essentially is gives you, I call it the new options chain. And the reason why it's new is because, and what makes it new and interesting is that any options chain will look like this. Okay, you'll have your bid offers, volume options, and it might have open interest, and it might have the Greeks and other implied volatility numbers. What I added here was this column. I call it the risk reward break-even price. Okay, and I added this up here where it says target price and confidence. So opportunity, the definition of opportunity on Wall Street is when your expectations, Bruce, don't match the expectations of the market. That's the definition of opportunity. And here we know I've basically given you what the expectations of the market are. Okay, so if you, for example, if we were going to buy the 15 calls today at $1.83, then we would have, the market is pricing in an expectancy of $19.16 as the final price at expiration.
So,
okay.
So our target price needs to be that or higher.
Right. It needs to be higher than that, right?
It's higher. Otherwise, we're overpaying for that option.
That's correct. That is exactly correct. And that's what the best guys in the world are doing. They are looking. Remember, I told you the toughest question in options is which one do I choose? If I was looking at Sonos right now, which one do I choose? And what the top guys in the world are doing, they're essentially looking. They're doing this quickly in their head. They're saying, if I buy the 15 calls and I pay $1.83, where do I make money? Okay, so I would make money at the break even here, $16.83, but I'm not going to pay $1.83 to make 50 cents, right? I'm going to pay $1.83 to make hopefully $2, right? It's almost paying $1.80 to make $1.80, right? It looks like $14.90 is right at $15. So it's almost a 50% up and down, right? It's like it can either be down below 15 or up above 15. So I'm not going to pay $1.80 to make 50 cents. I'm not going to pay $1.80 to make $1. If I'm going to pay $1.80, I got to make more than probably $1.80. It's like playing a game of heads or tails.
Sure.
So if I got to make more than $1.80, that means this option's got to be worth $3.60. And if it's worth $3.60, then the option's got to be worth $18.60. Okay?
And if we're overpaying for that option, we're already in the hole when we start. And
That's
we
correct.
not even know that we overpaid for it.
Exactly. And without knowing this, without knowing these numbers, which no one gives you, okay?
Yeah.
You're right. Options from a 30,000 foot view, options are a probability game. And the only way to play a probability game, the only way to win at a probability game is through a concept called mathematical edge, which is essentially what we're calling here risk reward, okay? And whether it's poker or backgammon or any probability, heads or tails, it's always about mathematical edge. It's a simple formula that I teach. But essentially, this tool does all the analytics for you. It does all the calculations. What it does ask you is for a target stock. It asks Bruce, what target stock price do you have? Does Bruce have? Because frankly, that's the only thing that matters. It doesn't matter what I think.
And we want the target price to be something that has a high degree of confidence.
That's right.
Yeah.
And let's call it 20. Now, what I did here was I added shading. And why did I add the shading? I added the shading because the option chain could be fairly confusing. And so what we're doing here is we're highlighting this window of opportunity, if you will, where the best in the world generally are buying options. Okay? So if you were thinking lower, then 12.5 would be an option that the best in the world would consider if they thought the stock was going to be lower than 10.15. Okay? If you thought it was going higher, you got to start thinking in these levels up here for options to be worthwhile. So what the computer does is essentially takes out all the thinking. It simply says, Bruce, what do you think? Do you think 20 bucks? If you think 20 bucks and you have this confidence level around here, 70%, 80%. And what I mean by that is, you know, if you were 100% confident, which you should never be, it's giving you 15 as the price. If you're 80, 70%, you could see it's starting to move lower. As you go lower in confidence, it's basically telling you, you know what, you're moving out of the range.
Wow,
so about 80%, right? Because confidence is basically saying, listen, I know it's going to 20. If you know it's going to 20, then the 15 calls are absolutely the ones to give you. Why? Because they're giving you the highest percentage.
Now, Felix, I have to ask you this because what stopped me in my tracks when I saw you make this presentation here a few weeks ago, is the point figure analysis that we do in Wyckoff, because therein lies the target price analysis. And I'm like, oh my gosh, we have an answer to this.
That's right.
Potential answer. But the other part is that the confidence level is a little bit of a mystery, because how do you establish confidence? That's
correct. And so what I tell people, I explain it by telling a story. I simply say, at a hedge fund, an analyst is coming up with an idea each day, or he's developing an idea over the course of a week. He shows up in front of the hedge fund, owner, and says, I'd like to buy this particular stock. And he pitches his idea. The hedge fund owner partner says, do you risk your career on this trade? Is this the one? Are we going to put all our money in this trade? And he starts reading sort of how confident someone is on the idea. Because clearly, Bruce, when you look at a trade or you look at a chart, you could say, you know what? This chart, I'm more confident than the last chart. So this confidence level is something that's unique to you. It's sort of having you say, this is a top trade. Options are reserved for the highest confidence trades. So the best guys in the world, the guys with the most money, they're only using options when they have a lot of confidence, or they have a lot of confidence in the risk reward analysis. And I'm going to give you an example. You can look at Steve Cohen's 13F. Steve Cohen at 0.72. His 13F, he probably has 50 stocks there, okay? But when you look at that 13F, what you will see is that not only, but 8 out of the top 10 positions, 8 out of his top 10 stock positions, he also has options, call options, okay? Going from 10 to 50, he probably has 1 or 2 more options placed. What does that tell you? The question you should have, or anyone should have, is why did he pick those 8 out of 10 right at the top? Why did he pick those? How come, what happened on stock 15 and 16 and 17 in his portfolio where he just owns the stock? And that should tell you exactly what I'm trying to say to you. Options are reserved for the most confident place. So when you're looking at one chart, you might be more confident with the way you might be more confident in that chart than another chart.
And
And
so this
that,
is
go ahead.
this is something we gain a feel for as we do this more and more. And
That's correct.
yeah, okay.
That's correct. So even, well, it could be confidence on the idea. So if I didn't even show you, let's assume you didn't even look at options yet, and I just showed you the chart, and you're looking at the chart of, here's the chart. You look at the chart of SONO, and I can say, tell me what you think, and you look at the Wyckoff, and I'm going to let you do that in a second, and you look at it and say, you know what, it looks pretty good, and I think this thing can get to 20, and then I'm going to ask you, how sure are you, right? And you're going to say, yeah, this is one I'm really sure. This one, it could come off, it could come back. And, doing Wyckoff for so many years has given you enough confidence to say, I like this one a little bit better than the other one. And it's the same, that's all it's asking. It's saying, how confident are you with this idea?
And then circling back to your tool is that the areas here in the calls that are not shaded or are highlighted are the ones that have the best reward risk relationships.
That's right. These all that are not, first of all, you're looking at calls because you think your target cycles are going up. So we can disregard all the puts. Just disregard that side. Yeah. Over here, what I highlight here is out of the money options. And those are the ones that the hedge funds buy. And the reason why they buy out of the money options is twofold. One, they want the leverage. Okay, out of the money options have the most leverage. And two, what I tell anyone that's learning, think about Wayne Gretzky. Wayne Gretzky wasn't the fastest guy. He's not the biggest guy, yet he's one of the greatest hockey players ever. And he made his famous statement that he doesn't follow the puck. He goes to where the puck is. He ends up where the puck is going. Or I forget the slogan. He anticipates where the puck is going to be.
It's not where it is now. It's where it's going to be.
Exactly. And so if you think of a stock as the puck, and the target stock price, your target stock price, or my target stock price, as where I anticipate or where you anticipate it's going to be, okay? We're trying to find an option strike that's somewhere in that middle. And why? One, because it's cheaper today. It has less value than the ones that are closer to the stock, and it carries a lot of leverage once that stock starts passing through the strike going towards your target.
All right, okay. So now at this point, because we are tight on time, yes, let's go ahead and move to your two ideas that you have for us.
Perfect.
Point and figure. I'm going to pause here and we'll be right back. Okay, so here we have Sonos up, which is our stock idea, our case study for today. And so we've done the point and figure now, or we have a point and figure chart. And this is the part that really got me excited about watching Felix run his tool, is that we can do point and figure analysis. We see here with Sonos, we see that we have a count, an accumulation count here. And we're doing this just a real simple analysis. So it's 2, 4, 6, 7. So we have 7 columns across, 3-box reversal, half-point scale. So 3 times 7 is 21, times a half, so that's 1050. So 1050 is our count, and we take it from the low and from the count line. So this basically puts us at $20 to $20.50. So let's just call it $20.
That's awesome.
This is our count, Felix. So this is how we can use horizontal point and figure counting and objective and building a price objectives with your tool. And
that's interesting. Yeah, that's combining that is interesting because it gives me more confidence that the way I'm looking at it and reading the options, board and what my tool is saying and looking at this and having you tell me a very similar point, it gives more confidence to what we're looking at and what we're buying and probably what the large institution is buying and looking at.
Now, the other thing that we can do, which I've talked about here, but we could combine it maybe at a later date with your tool is that there's swing trading counts that we can take. And there's a way we can count point and figure on a smaller time frame and do swing trading counts, and then we can do campaign trading counts, which would be longer time frames for options, say with longer maturities.
I like it. What I'm thinking, Bruce, that would be really educational. You next time you can come up, pick any option, pick any stock that you like, and come up with sort of an idea of where the stock is going to go, and then we can verify that whether or not that thought has edge, because that's what the tool does, right? Because the tool is going to basically tell you, you know what, Bruce, you got an options trade right there. That's pretty good. Like whatever you're looking at, this is the right option that you should play. So it always starts with what you're looking at.
And so point and figure could be really a great tactical tool to be able to add to this whole analysis. And this is the part that really I thought was so compelling. And of course, just to clarify, people that use your tool, that subscribe to your tool, can look up any option series that they have an interest in. So in this case, you did the analysis on Sonos, but they may have an analysis on some other stock.
On any stock. The market, any stock that has options prices.
Yes.
And a trading, the market is in the market. You have to think about the market price of the options have an embedded expectation. And all I'm doing is I'm taking a tool to show you that expectation and then compare it to what your expectations are. So if we started back, I had to go backwards to explain the idea in the tool. But now if we went forward and you picked Baba or Apple or Facebook, the market is smart. They have their expectations built into the options market. What you're trying to do is find charts that are showing something that perhaps the options market hasn't picked up on.
They may not be expecting.
That's right. That's opportunity.
Felix, what a great discussion we've had. We love seeing your tool. There's great educational materials on your website because I've looked at them. Options do have risk, so everybody make sure you understand the investments and the trades that you're making and the tools that you're using. But in the meantime, Felix, will you come back and see us again?
Absolutely, anytime.
Well, you're wonderful. Thank you so much, and we will see you all next time.
Thank you.
This is a brief demo about how to scan for things that made a new high earlier in the week or the month. Rather than using a daily scan, which would say that it didn't make a new high today, by using a monthly scan, it'll get anything that was above this previous time period. So to do that, we go into technical scans and we create this month's high is greater than last month's maximum over the previous 12 months. I've also set it up with a close greater than $5. But when we run that scan, obviously it brings us our data, and what we can do is we can sort it into industry and sector, and Buckle was the current stock that I had up there, but look at how many apparel retailers are also hitting new highs in this current month. So this would lead you to believe that there's some strength in that sector.